Good morning, traders and investors around the world. Welcome to this October 10th, Columbus Day edition of Pre-Market Prep with StockOdds. Joel Elconin, joined by Rob Friesen, who has two pressing topics to discuss with you today. We're down, not by much, 6 handles, trading at 47 and a quarter. Ooh, 10 handles, just a little drop there. Little volatility, made a run at the pre-market high, got turned back by 2 points. Came back down, challenged the low from yesterday, which was Friday at 32.50, and now we're just kind of meandering in between. The buck does not stop up 38 cents, 113.06 and a half. TLT, no chance for rates going down. That's down a $1.50, 99.49. Crude, that's up 44 cents. That's not good for inflation. We are up 42 cents at 93.06. Gold, that's down 28 bucks on the week dollar, 1681 and a half. Silver, that's in the red by 52 cents at 1973. Bitcoin in the red fractionally, and so is Ethereum. While we just had a little bit of a bear move there. Not sure what that was all about, but some choppy holiday action. Rob, you got a couple good topics for us. Where do you want to start?
Well, as an E-mini trader, how do you deal with when bond markets are closed? For the most part, not all bond products are closed, but most of them. Right?
The minis are the minis. My numbers are the numbers. Things don't change too much.
Well, I look at it kind of like, Big Daddy's not around to keep the S&P honest.
Yeah, I guess that's one way to look at it. I mean, I still think there's, even though the bonds are closed, I mean, they're still trading the TLT and stuff. But you're right. There might be a little bit more, hanky-panky going on. I'll agree with that.
Well, I mean, sometimes institutional activity on the equity side has a relationship with bonds for hedging purposes and things. So it can dampen it a little bit. Not only that, you're going to have a little bit less institutional activity, perhaps. And with today, Canadian markets are closed. So the institutions in Canada that trade on the US listed exchanges are not active. So that could lower the volume as well, right?
All right, very good points.
So we got a little bit of a lighter volume. Some markets are disrupted, and then we have the macro picture. We've got, Putin brought in his Syrian general, which is has a reputation for bombing civilian targets. So we got all across the Ukraine today. We have targets hit, including the Samsung Tower in Kiev there, right?
So not letting up.
Retaliatory, right?
Right.
I think there's a saying, don't poke the bear or something. So there's obviously a retaliation there. Anyway, moving on to trading subjects here. Let me share my screen. I just wanted to wrap up something from Friday here. So on Friday, we talked, or planning for Friday, we talked about the first of the month seasonality and a first Friday of the month seasonality. I mean, there's different seasonality events that happen throughout each month. We have the ones that we feel are relevant reported in our seasonality almanac. So you've got the first trading day of the month was the first event, then the first Friday, then you go to mid-month seasonality and so on. So one thing I want to point out is that the beautiful thing about the seasonality almanac is that you get to look at it before you ever get there. So if we want to plan for the end of the month, we can look and we can see what tends to be favored, what tends to be out of favor. We can look at it through the lens of ETFs and therefore look at the sector ETFs as well. We can look at it through the individual stocks. So this helps you plan. And nowadays with trading, it's a lot more, I think, on the research side and having your data than it is on staring at the screen, watching every tick and trying to outsmart the market and outsmart all the
Can't do
algos,
that.
right? So, I mean, that's why swing trading can be good, but obviously swing trading hedged can be more insulating than swing trading naked. But research is a big part of, being successful at trading these days, maybe more than it ever has been. And then that can be tough where, like even today, I think the market, from last week's sell-off had wanted to rally today. And I think that the sort of backdrop of what's happening in the Ukraine, the backdrop of, again, the dollar moving up a bit, the backdrop of some central banker yakking this morning, and some
Too
other
much bad news
well,
out there.
other commentary on the inflation and recession side just kind of put a damper on things. These are respected people that markets listen to, so it kind of just really squashed that appetite to rally. But anyway, my point here is, as we approach the mid-month seasonality window, the edge goes to things that are significantly discounted before the window and looking for that divergence of what's been happening versus what may be expected. So that's one part of it. And the other part of it is, are there any macro or other arguments sort of against what's portrayed in the seasonality window? Okay, so you can use it, but it doesn't mean it's always going to work out perfectly. So since we looked at this on Friday, we reviewed some of the symbols. We'll just follow through here and say, how did it do? So we selected only the symbols with odds over 50. So that wouldn't have allowed, win to be in on the long side and so on. So just the symbols that are over 50. And then again here, symbols that are over 50. So it wouldn't allow T-Doc to be in there. And then taking those shorts and taking those longs, we had a few more longs than shorts, so we bumped up our SPY hedge to 5,000 or 5 units of SPY. And again, traders can look at this, say doing it for the day session from open to close. They could adjust the capital that they want to use based on the stock's volatility, or based on the stock's beta, or based on the stock's ATR, or a combination of that. That's up to you. You could also use limit orders at the open to define your risk and not pay up 8% or 10% on something that's gapping. So this is what we call a baseline approach, where you're just simply taking the open at market and the close at market, and you're just putting an even amount of capital on per idea. Okay, so if the baseline can perform, can you do better than that as a human with all of the things that that's the question. Okay, but 0.33% return on capital, that's the way we evaluate a lot of things. Is it doesn't matter if it's a small trader or a large trader, it's all relative to your account size and your skill set, but what is the return on capital that you're making? That's really important. And we like to see, obviously, a positive return on capital on a regular basis. Look at when you're doing basket trading and pair trading and so on, look at your profit or loss more on a weekly basis rather than each and every day, because you could have 1 or 2 days down in a row and still might have a positive week, and that's the way to look at it more so. Okay, so that's seasonality. So the next seasonal event is mid-month, starting on the 13th, which is Thursday, which is the same day we get we get CPI numbers on Thursday or something, I think. So
Thursday, and then you
we
get
have a
some
jobs report
earnings.
as well. Yeah.
Yep.
Okay, and banks earnings start on Friday, so that's going to be a big day, right? But what I want to point out is the seasonal. You have seasonal money flow in the sectors. You also have just macro money flow. So let's roll this back for a second here, all the way to what's happened with the 1 year. So if you notice, communication services, a lot in part because of Meta right? We had such a bad performance for Meta for the year. Consumer cyclical, so like the discretionary stuff, all got hitting on the chin. Technology. So let's just focus on technology for a minute. So we know the 1 year. Look at the half year, technology still there. Look at the 3 months, technology still in third place, worst performer. And technology in the 1 month here as well, down 13.86. And then the 1 week, technology still down 3.35%. And then, even today, following through again. So that means for an entire year, you've had technology, taking it on the chin. It actually started some of it started last September. So it is definitely a full year. We had a bit of, a few bright spots along the way. We had a few 1 week rallies along the way, but, this is the persistence of money flow, what I want to bring out, and the respect that's needed for where the money's moving. And you're not going to have, when I first joined Bright, for example, we had this little duck list chart that we kind of followed, and it was buy a strong stock in a strong group or strong sector, in a strong market on a pullback, within, at the time was like 3/8 or something like that. So that was like how to really play the money flow, how to really play the relative strength by selecting things that had a lot of, agreement or arguments, or the ducks were lined up. Where if you did this approach where you said, oh, well, here's a really weak stock, this has to turn around, it's got to rally for me, and you were, trying to pick bottoms on it, you usually got run over. Well, in some ways, nothing has changed in the last 24 years that I've been trading with Bright. Nothing's changed because money flow still dominates, and it is largely sector related. So here you have, technology taking it on the chin. It certainly could have rallied today, but what's the overall backdrop? You're not going to have a great time at going into a lot of these technology stocks for good swing trades until there's a complete sentiment shift, until people are really willing, to tackle this group and, buy it for holding for the next, 5 to 10 years, or trading it even on the short term. But you can see that the sentiment just doesn't support a risk on environment yet. Now, we had a rally first few days of October. You could chalk that up a little bit to the turn of the month effect, perhaps, because we ended a quarter really bad, down 7%. At that point, we were down 28% for the year. So it was like, wow, this is fantastic. What a discount. And it's a brand new month, and October has had some of the biggest rallies in it too. So let's go. And there was a bit of a risk appetite for a few days, 3 days to be exact, which then got run over, right?
Yeah.
So now we've got a situation where you do have to still be prepared for, the market wanting to rally, but the overall theme, looking at all of the picture, it's still more likely that we test the October low, that we possibly break through it, and we have another down spell before it all gets worked out of its system. Now, I'm not going to be a doom and gloom guy, but you have to look at, the macro landscape. You have to say, well, we're going into a winter, Europe's going to have a real hard one. How's that going to affect, European investors? They're going to continue to still want to put money into the US markets too. You have to look at the whole picture, guys. But just respecting the money flow in these particular groups can help you stay out of trouble. Now, with the dollar being up again, basic materials are actually stronger than you would think, because they should be impacted by that dollar. I can see consumer defensive can be a good argument for today. Obviously, utilities had a pretty bad spell, not on the big picture. Like if you go back to utilities were doing okay on the 1 year and a half year and so on. But what happened recently is this problem with potential price caps, restrictions on how they can pass on the costs to the consumer not being able to pay or not willing to pay. You've got regulatory environment, you've got a bond component with interest rates rising, while the utilities have bond components. So, I mean, it's really a tricky space.
A crowded trade too,
and it was a very crowded trade. It was a very defensive, very good performing, but very crowded trade. And you're right. And so that's why this last month or so, utilities started to really get, hammered. And then the 1 week was horrible. I mean, some of these utilities are just like literally in 4 days erasing what took 2 months to build, 3 months to build, all year to build. So we've had some real sell-off in utilities, but even those can bounce back a little bit, as you see here today. I was looking at some of the stock odds on the utilities themselves, and there was some really good candidates to go long. So, consumer defensive materials and utilities and industrials and even REITs are winning out today. And we'll see, but try to align yourself with the sector money flow and always kind of do the contrarian takeaway where you're asking, well, is there potential for mean reversion here in the group? And I think there can be those spontaneous bursts of mean reversion for 1 day, like all of a sudden you could see technology, really shine. But in order to get proper traction, it has to be like that example we've given before, where the deer comes out of the woods and it just doesn't charge down to the stream to drink right away. It's got to look around and say, is it safe? Am I going to get picked off here? And so it moves down, more carefully and looking around. And the markets are like that. They're going to, maybe deploy, put some money to work, and everybody jumps on board. But for that to be sustainable, the climate and the sentiment really has to change. And when it does, you've got, plenty of upside. Don't get thrown off by these percentage moves sometimes where we have, the markets are up, this stock's up 10%, this is up 20, this is up 30. Well, I mean,
not the norm. Yep.
But if they fell, if they all got haircutted by 50%, it takes 100% to get back to where you started. So the numbers, the percentages, wow. But at the end of the day, you've got time. If the sentiment really changes, you've got time to get involved. And, Qs will be strong day after day for a while under that scenario. I just think there's too much to be concerned about, where you want to continue to play defensive, you want to continue to play hedged, and you certainly want to respect these groups for money flow and try to swim in the river with the river direction and not against it, because it's much tougher. Okay.
All right. Well, trading down near the lows of the session, haven't taken out the pre-market low at 36.18, but that kind of seems like where we're heading here on this Columbus Day. Low close of the move, 36.01 and a quarter. Sure like to avoid that. And then for me, the actual low of the move that was made in pre-market trading a week ago Sunday, 35.71.75. If you want to try and be a bull just for the short term here, maybe get above Friday's low at 32.50. That's it for pre-market prep with stock odds. Thanks again. Let me see if we got any questions. No questions, Rob. We will let you go and enjoy your Canadian Thanksgiving.
Thank you, sir.